Alrighty, we are looking at share investment now, and just doing a bit of a short session on what are shares and what do they do and why do we have them. So we normally hear things about the share market, and the share market we normally kind of picture as being something that has a bit of a graph and it goes up and down like that, and you always hear these things about, oh my goodness, the market's crashed and everyone's getting upset, or the market's going really well and we're really strong. So what do these actual things mean, and how do they link to us as people in real life? So let's have a bit of a look at why we actually have shares to start with, and that might kind of help you think about why the share market kind of works the way it does. So let's start with a simple example. Let's say that you've got a cupcake shop and you're selling cupcakes and it goes really well. Now, shares don't necessarily have to be a product. It could also be like a service. So you might have a service there that you're offering, but you might get to the stage where your demand is going really well. So people really, really want your cupcakes. So you've got to make more and more and more and more. So if that's the case and you've got to go more and more and more, then you're going to have to expand. Okay, so you might have to expand and get bigger. You've got a couple of choices when you expand, because the fact is you want to have more people working for you, you're going to have a bigger turnover, you're going to have more expenses, and unless you're saving lots and lots and lots of money up while you're selling your product, it's going to be hard to save up enough money. So if you can picture the thing that's going on is that you've suddenly got all these cupcakes being sold and it's getting bigger and bigger and bigger, and you go, okay, I'm going to expand, I'm going to make that decision, and you've got probably two choices here really. You can probably go to a bank and borrow some money, or save is probably another one, but this might take a lot of time. Or you can float your company, which basically means that you will list it on the share market. Okay, so you want to get some people involved in kind of like sponsoring you. This is probably a good way of doing it, but actually buying into your company. So what you do is you say, okay, I'm going to release a whole lot of shares on the market. Now you just can't put an advert out and do it. You've actually got to go through a whole lot of rules and regulations that the Australian Stock Exchange put out. But simply, you say, I'm going to float my company and I'm going to put it out there and sell bits of it, sell shares of my company that other people will want. So hopefully all these people come along and go, you Ripper, I want to get some shares in this company. And this is called a float. Okay, so your company's been floated. So someone might get one share like that. Someone else might grab two, over here. Someone might grab three. And this other person might grab two. So, they're buying shares of your company. Now, whoever has the most shares, if you have over 50% of the shares, you control the company. Okay, so that's when they talk about company takeovers. If 50% of the shares go, they can now control the company. So if you are a person that set up this company, you're really going to want to have at least 51% of the shares. So you want to set it up so you can actually buy those 51% of the shares so you still control it. Because as soon as you have a company where you've got shares in it, there are implications to that company. Okay, so what this means is, the implications are like this. You have joint ownership. So what that means is that everyone has a part ownership of that company because they share in the company, which means that they've got voting rights. So they can actually vote at an annual general meeting about directions and the way they want to go, who's going to be on the board of directors, and who's going to be the controlling people. So once again, you want to be able to have 51% of the shares at least floating around there so that you control the company. So voting rights kind of change a little bit with the types of shares, but generally, one share, one vote. And also it means there's a share of the profit. So all these people now get to divide up the profit, and the dividing up of the profit gives everyone a bit of what you've made. So you've got to divide up the profit so that everyone has a bit of it as well, which isn't, it's not a bad thing, I suppose. Now, so you might be thinking, okay, so you got these shares. What does it actually mean? Well, what it means is like this. Let's have a look at this kind of thing. So if you've got, you've got some shares and you sell them for, say, $1 each. You have a whole lot of shares. And you have, say, 100,000 people investing in your company. You suddenly got $100,000 to use for your company. Okay, so you've got that money straight away. They buy shares in your company, you get the money, and then you can use it to build your business up. So it's very, very cool. If you borrowed that money from the bank, you'd have to pay a percentage on it. So you'd have to pay a loan out, and then that gets really quite expensive. So you don't want to go down that pathway. So 100,000 people want to join up, 100,000 shares are floated. You sell them for $1 each, you get 100,000 bucks to play with. So you can imagine if you've got millions of shares, you get millions of dollars in. Now, what makes this whole thing go up and down? Because you're probably thinking, well, hang on a tick, that's all cool, but why do share prices go up and down? Now, if your cupcakes are going absolutely fantastic and the demand is great and the quality is good, demand goes up, quality is great, goes up, then these shares, they might have started off at $1. People might be saying, hey, they're now worth, because this company's going so well, they're making lots of profit, these are now worth $1.50. Okay? So people will pay a bit more for it. So the value of your company goes up. So on paper, the equity of your company is going through the roof because you've got the shares are now worth this much dollars each. Now, they can keep on going up like that as long as the demand's there. But if something goes wrong, suddenly you have your cupcakes have got something wrong with them. You've got some sort of dodgy ingredients in there, so they go yucky. If that happens and your demand goes down and no one wants them, your profits go down, your profits drop like that. Then what's going to happen is your share price, instead of staying at this 150 here, might even go down to between 90 cents. It might actually drop below $1. So then you start losing money. So there's this game of making sure your product's good, making sure your company's good, and keeping that confidence in the market so that people can then buy and trade your shares. So if you're going really well and an existing shareholder wants to get rid of some shares, they can sell them and they might make a profit, and someone might want to buy them. And then they can invest in your company. So that's why people buy and trade shares. A bit of terminology. When the shares are first released, if they're at $1, that's called the par value. The par value is the price that they were first released at. And then if they are trading higher than what they were first released at, that's above par. That's very kind of unique way of naming it. And guess what it is when it's actually trading underneath what you floated them for? That's called below par. Okay, so the par value is what it was when it was first released at. Above par if they're trading above that, or below par if they're not. Now, in the next kind of videos, we're going to look at how to buy and sell the shares, because people want to trade these things. If they're going well, people are going to want to put money into your company. If it's not going that well, they'll probably want to get out, and so your share price will go down. Cool.